Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It is Bloomberg Business Week on this Friday. Carol Masser, along with Katie Greifeld, she's in for my co-host Tim Stenovec, her co-host, who also over on Quick Take. We're tracking, though, all those COVID headlines that are constantly, Katie, safe to say, keeping us all on our toes.
Yeah, absolutely. I mean, you had a ton of bank headlines, but every single day you get a ton of COVID headlines. Moderna chair saying the pandemic we're living in, well, maybe it's going to become an endemic sometime this year. That's just one of many, Carol.
All right, well, we'll catch up with Dr. Ian Lustbader over at NYU Langone in just a moment. Right now, though, let's get you caught up on all of the day's headlines. Another busy one. Here is Doug Krisner.
Hey, Carol, financial shares are weak with the S&P Financial Group down about 1.5% right now. We heard today from J.P. Morgan Chase and its rival Citigroup, each posting a steeper than expected drop in trading revenue. And we also have real estate and consumer discretionary a bit on the back foot today. But generally speaking, it's been a tough day for the equity market if you're long economically sensitive stocks in particular, leading this decline after some disappointing economic news, particularly that retail sales number, a big drop, the most that we have seen in about 10 months. Dow Industrial Average weaker by 1%, the S&P 500 down 0.5%, NASDAQ comp trading lower by just 0.2%. We've a 10-year treasury now with a yield of just under 177. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, really appreciate it, Doug. Thank you so much. So we are continuing, as Katie mentioned earlier, tracking those headlines when it comes to COVID. We have B of A pushing back its return to office for staff in the U.S. again until at least the fourth week of January. Katie, BP telling its employees at its largest U.S. office in Houston to work from home until next month due to those rising Omicron cases in Texas.
Yeah, I mean, those headlines coming hot and heavy. It almost begs the question, I mean, who hasn't pushed back the return to office date at this point? I'd love to know.
It's a really good point. Let's see what Dr. Ian Lustbader has to say. He's clinical professor of medicine over at NYU Langone. We check in with him every week, and he joins us on the phone in New York City. Dr. Lustbader, nice to have you here with Katie and myself. How are you? How are you feeling?
Much better, thanks, Carol and Katie. A pleasure. Last week, I was sick. I had thought perhaps I had COVID. I tested negative, but there are many other viruses going around, RSV, respiratory syncytial virus, flu. We don't really test for all of them, and we're seeing a ton of people call in either COVID positive or with symptoms that turn out to be negative. So people are in a bit of a panic, and many patients are saying, oh my gosh, what do I do? Is there some treatment for me? And unfortunately, there's a lot of limited treatment. A lot of what we have is really regulated by the state and limited to either elderly people or people with significant underlying medical problems. So people feel very frustrated.
And Doctor, I am curious to hear your perspective on what the path forward looks like. Because, like I mentioned a minute ago, we did hear from Moderna co-founder today saying in a Bloomberg television interview that 2022 is going to be the year that this pandemic turns into an endemic. Would love to hear your thoughts on that. First of all, would that change our day-to-day life? And also, do you think that's a realistic timeline?
I do for both. I do think that this will turn into an endemic problem, which basically means Omicron will be like a seasonal flu. We get hundreds of thousands of cases of flu every year, and unfortunately thousands of deaths from flu every year. The flu vaccine helps. It's somewhat limited. It doesn't work 100%. I do think we're seeing really a plateau, and soon we will see a drop in the number of cases. Certainly in some areas we're seeing that already in the Northeast. So I think the number of Omicron cases and COVID cases will be dropping in the next few weeks. We still are seeing some hospitalizations and some deaths, but overall this does appear to be much more mild. And I think until we really are able to eliminate it, and we may not be able to do it, we will just have to live with it. And Omicron or COVID may be another seasonal coronavirus, and we have many coronaviruses that we test for in a nasal swab, a PCR nasal swab. It's called a respiratory panel. When people come in, they're sick, either in the emergency room, sometimes in local offices. We do that swab, and it tests for, 10 or 15 different viral pathogens. And I think Omicron, and this will be another coronavirus that we'll be testing for. And hopefully we will have some antivirals like Tamiflu. Right now, a lot of the medications like the IV monoclonal antibodies, Sotrovimab, very limited in amount. Paxlovid has a lot of drug interactions. So we really just offer people supportive care, and fortunately most people do well, hydration and mucus thinners and cough suppressants. So sadly, we don't really offer people a lot of magic bullets. Hopefully over the next year or so, we will get more effective therapies.
What is it, though, Ian, about, we've been talking with you throughout the pandemic. I'm going to be fully transparent. I tested positive for a rapid test, and I'm at home. No symptoms so far. But I have to say, I had felt so lucky navigating up to this point. And it was real shocking to me. And I'm like, what is it that... I know you have said to us, everybody's going to get this. It's just the way it is. It's getting much more contagious. But it is still scary because you do talk to people who said, it was nothing. And then there's other folks, younger folks, older folks, you name it, who say, I was knocked, off my feet for a couple of weeks. What is it about this virus that is still so tricky?
Well, many viral infections knock people off their feet. They do cause fatigue. We don't really know all the details about this coronavirus. We certainly know the mutations. The real origins we've talked about, are still a little muddy and murky. And so it's unclear whether or not, this was engineered in some way. But it's certainly a very effective virus. It's highly contagious. It's obviously mutated to be much more easily spread by people who have no symptoms. Hopefully you're young and healthy. Hopefully you'll have a pretty simple course, but you may have cough, sneezing, sore throat, laryngitis. Bad for an anchor to have laryngitis. But usually within 10 to 14 days, people will get over it. You should speak to your doctor. There are some people, if they have bad coughs, we'll give them a short course of steroids to decrease some inflammation. But most healthy people will get over it. If people have underlying problems, that really puts them in a different risk group. And there are some therapies like monoclonal antibody, although it is very limited. It's regulated by the state. You can prescribe it. It has to go through a committee that has to screen people. But I think most people, you're a perfect example. You've done everything right. And if you look back over really a century, there are very few pandemics we've successfully dealt with. Smallpox took years, decades and decades of slowly getting everyone vaccinated. So I think it was unrealistic to think we could sort of jam everyone in with a vaccine that honestly is not totally effective, right? People have 3 shots, they still get Omicron. So I think it was unrealistic without tremendous preparation, lots of masks, lots of tests, lots of treatment to think we could have really succeeded.
Well, we're glad to hear that you're doing okay, and I love you forever that you were calling me young and healthy, so I'm all in. Hey, be well. Dr. Ian Lustbader, clinical professor of medicine at NYU Langone, on the phone in New York City. Let's go out to D.C. Nancy Lyons is there in our D.C. bureau. Hey, Nance, with World and National News.
Thanks, Carol. Another blast of winter weather is making its way from the Midwest to the East Coast this weekend. Some parts of Iowa and southern Minnesota could see as much as a foot of snow along the way. Meteorologist Bob Orevec with the National Weather Service says this weather trend is expected to last for the next few weeks, especially along the East Coast.
We're in a fairly active, at least active and cold weather pattern across the eastern U.S., and it doesn't appear that we're going to be changing that weather pattern probably until maybe early to mid-February. So it looks like we have the potential going forward after this storm for additional winter weather across the eastern U.S. For the remainder of January, possibly into early February.
Orevec says starting Saturday night, much of the eastern U.S. is expected to get snow, sleet, and freezing rain. The recent Omicron surge is not just affecting business, it's also putting a crimp on many government services most of us take for granted.
Just take the Transportation Security Agency as an example. Right now, more than 3,500 workers are infected with COVID at the agency that handles airport security across the country. The shortage forced 2 checkpoints to shut down at Phoenix Sky Harbor last week. Then there are shortages of inspectors at the USDA. That is slowing meat production and raising prices in Wisconsin, Nebraska, and Texas. An inspector shortage at the FDA could mean new drugs and medical equipment don't get approved as quickly. And the IRS is already warning of delayed tax refunds reductions due to funding cuts and COVID staffing shortages. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Just think.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in the nation's capital. You are listening to Bloomberg Business Week on this Friday. Carol Masser, along with Katie Greifeld. She's in for my co-host, Tim Stenovic, who has been off for a few days. And Katie, safe to say I've called it a Fed palooza. I think other people have as well. But there have been a lot of Fed speakers, including Jay Powell earlier this week, talking about monetary policy, talking about interest rates. And let's add John Williams to the list as well.
Yeah, John Williams, Federal Reserve Bank of New York president, talking today at a virtual event hosted by the Council on Foreign Relations. The message there was that he said that the decision on rate increases, it's approaching the economy. It's in a good place for Fed policy to start to evolve. And I mean, everyone expected this. Obviously, there are 4 rate hikes priced in this year, but to hear it again from someone who has a decision to make just sort of solidifies that pricing.
Right, and we always listen, though, also to the New York Fed presidents, right? Like, they certainly have, I think, the ear of many in terms of the financial community and so on and so forth. It is interesting. It just mirrors very much what we've heard from so many other Fed members, Jay Powell himself. As for specifically what he said at that virtual event, the next step in reducing monetary accommodation to the economy will be to gradually bring the target range for the federal funds rate from its current very low level back to more normal levels. He also goes on to say, given the clear signs of a very strong labor market, we are approaching a decision to get that process underway. I mean, Katie, this really goes to that dual mandate, right? It's keeping prices in check, meaning inflation, and then keeping an eye on full employment. And it does feel like maybe this is full employment. The rates have come down a low. I know we talk about labor participation, but it does certainly feel like, and that's in place, and it certainly does with prices, we know, way up high. Even if they may settle in after the economy gets back to normal, it's hard to ignore those levels.
Yeah, I mean, among the Fed's top brass, it really feels like the focus has turned to inflation, that by and large, I mean, they're happy with the labor market recovery, but those see a 7% inflation reading, that would make anyone nervous.
Yeah, exactly. All right, you're listening to Bloomberg Business Week right here on Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market is a little on the back foot, but we are off session lows. The NASDAQ composite right now is essentially flat. We've got the Dow weaker by 0.9%. If you look at the broader market, we've got the S&P weaker by about 0.4%. In the minus column, I'm seeing real estate along with financial and material names. On the positive side, energy, information tech, and communication services. Now, in terms of the energy story, we have many in the group moving higher in lockstep with crude oil, WTI in New York, nearing $84 a barrel. We are up by more than 2% now in the regular session, and the S&P Energy Group is higher by about 1.9%. Crude oil is heading for its fourth weekly gain as the market continues to focus on tight supply. We're also seeing a mild recovery in many information technology names, with the S&P Infotech Group now higher by about 0.4%. The day's economic news was disappointing. Retail sales down in December by the most in 10 months, and growth at U.S. factories unexpectedly fell. Persistent struggles here, not only with materials, but labor shortages as well. At the end of the day, it looks like we've got to move up in long-term interest rates. A 10-year Treasury just under 177. We heard from the president of the New York Fed Bank today, John Williams. He was saying inflation is too high, and the Fed will work to bring it back down to that 2% target. I'm Doug Krisner, and that is your Bloomberg Business Flash.
We know another guy who thinks that it's too high. We're going to get into that in just a moment. Doug, thank you so much. Well, safe to say there's at least a generation, at least one, if not more, who may not be familiar with the original Dr. Doom, better known as Henry Kaufman. Well, our Bloomberg News editor-at-large, Eric Schatzker, caught up with him and joins us with more on their conversation, which I have to point out is getting picked up big time on social. Eric is on the phone in our New York City bureau. Eric, thanks so much for coming on with Katie and me. Thank you. First of all, Dr. Doom, Henry Kaufman, right? There's probably a lot of folks out there who've never heard of him.
Of course, because he was a huge figure on Wall Street several generations ago. We're talking about the 1970s and the 1980s. He was the chief economist at a firm that no longer exists, Salomon Brothers, the same firm our own Mike Bloomberg used to work for. But back in the day, Henry Kaufman was a market mover in a way that almost no one can be any longer. In 1982, he declared that interest rates would go down, sort of secularly, if we could use that term, and it spurred then, at the time, the biggest single-day increase in the S&P 500 to date, and ushered in the bull market that lasted until the dot-com bubble burst in 2001. So it's all just to say, Carol, that Henry Kaufman was Wall Street's authority on the bond market and monetary policy for an awfully long time, and he earned the nickname Dr. Doom because he was critical of what he saw Arthur Burns doing at the Fed and what was going on with fiscal policy and the inflation that it created in the late 1970s.
And so, Eric, I'll admit I was not familiar with Dr. Doom, but reading about your interview with him, he's definitely living up to that name. And some of the prescriptions he would prescribe to Jerome Powell, urging the Fed to act in a draconian manner, saying that Powell doesn't have the stamina to tame prices, those sound like fighting words.
Well, isn't it so wonderful, so rich to have a 94-year-old Wall Street veteran, because he's 94, accusing Jerome Powell of not having enough stamina? It's incredible. But you're right. That is what he's doing. He has seen the whites of inflation's eyes in a way that very few people left on Wall Street have. Let's not forget that at the time we're talking about, the late 1970s and early 1980s, Jerome Powell was just coming out of law school, and he was a clerk. He hadn't even migrated to finance. And so, yes, Dr. Kaufman has seen what real hyperinflation in the American context, not the Weimar context, but the American context looks like when inflation is running at almost 15% annual. And he knows what it took to break inflation's back. It took the Saturday night special, the combination of policies that Paul Volcker, then the Fed chairman in 1980, cooked up on a weekend in October that ultimately caused inflation rates to moderate down to just north of 2%. However, that took 3 years. And he looks at today's inflation rate at 7%, and says, if you want to get down to 2%, you can't do it incrementally. You can't do it 25 basis points by 25 basis points, because the longer this inflationary period continues, the more inflation, the more rising prices become embedded in the American psyche. And once they're embedded in the psyche, very hard to dislodge.
You know, it's interesting, Eric, we've been having conversations in the newsroom about, we all remember being kind of surprised by the Fed, right? Walking in a morning where they did something unexpected, not at a normal meeting, and having that ability to really surprise and do something in terms of the markets. Does Dr. Kaufman think that this Fed, Jay Powell, well, he may say they're behind the curve, that they have the fortitude to do something much more aggressive or maybe surprise the markets because they really need to, especially when it comes to inflation?
He says they need to shock the markets, in fact, but he also says that they don't have the gumption, let's say, or the will to do that. What he would like to see the Fed do is exactly what you described, Carol, an intermeeting, sudden increase in interest rates. He thinks that they should start with 50 basis points right now, but also explicitly commit to raising interest rates further and put in writing that they will not stop, and when I say they, I mean policymakers at the FOMC, will not stop until they've tamed inflation. And only by being that clear to the market will the market truly believe that the Fed is committed as opposed to just talking about it.
And I mean, it's interesting to contrast Kaufman's views with what we heard from Jerome Powell this week. I mean, just this week, he told lawmakers that it's going to be a long road towards getting Fed policy back to a normal setting. Definitely doesn't sound like a man who is thinking about an intermeeting raise like that. And intermeeting, policy moves, they are pretty rare.
They're pretty rare. Well, one thing is clear. By the time inflation got to where it got in the late 1970s and early 1980s, it was an emergency. And it required really strong medicine. And that strong medicine, as strong medicine often does, had some side effects. And one of those side effects was increased joblessness. Now, Paul Volcker and his FOMC decided that the risks were worth taking. It's very clear that this Fed is very focused, and Dr. Kaufman would say, in part for political reasons, on maintaining a low unemployment rate and increasing labor force participation. And that, we have to believe to a certain degree is inconsistent with radically higher draconian interest rates.
Eric, you're right. To Kaufman, Powell is no Volcker, not even close. So what's Kaufman worried about? That if we continue on this kind of slow and steady course by this current Federal Reserve, what might be the outcome? And we've just got about a minute or so.
Well, what might be the outcome is double-digit inflation. And if inflation gets to the point where it is, where people begin to, as Dr. Kaufman put it, the average American realizes that his or her income is inadequate to cover inflation, then it has a negative impact on economic growth, because then people aren't just spending more because they're worried about what it's going to cost tomorrow. They're actually spending less because they just don't feel like they have enough money to be able to live adequately. And that becomes a very dangerous sort of vicious cycle.
All right, we're going to leave it on that note. Eric, thank you so much. I woke up this morning, was reading something from Bloomberg New Economy, and they had highlighted your conversation with him, and I knew we had to share it because it was just really impressive and so relevant to what we're doing right now. Eric Schatzker, he is, of course, our Bloomberg editor-at-large here at Bloomberg News, covers so much and really speaks to those voices who have history, understand cycles, and are really making some of the important decisions of our time. Katie, it's a must-read.
It's a must-read, really. Just some great details in this piece.
All right, you're listening to Bloomberg Business Week, and this is Bloomberg Radio.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, and Shonali Basak in the house, joined now by our colleague Katie Greifeld. We welcome our Bloomberg audiences across TV, radio, YouTube to dissect what has been a tumultuous week, and it continues to be a sign of big tech selling off, and even the banks get hit today, Katie.
Yeah, I mean, there have been 2 trading weeks in 2022. In both of those weeks, the S&P 500 has dropped. And what's interesting is you see the NASDAQ 100, the big tech names, trying to hold on to gains here, even as you have Treasury yields really move higher today.
Yeah, I mean, that is an about face from what we saw
yesterday.
They have
a bigger microphone that they can get to, Katie?
It's a little high. We're going to work on it
for
for
radio
4 p.m.
audiences, it's a little bit.
Yeah, it's, I think
maybe that's for Carol.
It's majestic. It's all about the camera angle, right? We'll get that fixed. Meanwhile, we look at what's happening in terms of the S&P 500, currently down 17 points, guys, down 0.4%. The bigger moves happening in the cyclicals. The Dow Jones off by 0.9%, 333 points below where it was to start the day. We're basically flat now, actually clawing our way slightly higher on the NASDAQ. So we're just less than 7 points basically lower on the day. But the Russell 2000, also their cyclical trade getting hit hard today, 0.6% lower on the Russell 2000. Maybe that's something to do with the all-important financials, Shonali.
Yeah, you definitely see that cyclical trade issue in the sectors, and that's with real estate being led lower on the day, 1.5% lower, more than the other indices. Financials not too far behind. We've been talking about those banks, materials, consumer discretionary, industrials, all in the red. Yeah. Energy is up.
Yeah, and we talk about the banks. I mean, the big decline that we're seeing in J.P. Morgan. I pointed it out to Shonali a little bit earlier. Actually, this is pretty commonplace for J.P. Morgan. Shares down 6.5%. In fact, pretty much going back to early 2020, every time they report earnings, whether it's a beat or not, the shares typically decline on the first day. Sometimes you see a snapback a little bit after that. Microsoft shares are higher on the day by about 1%, still going to finish the week down by about 2%. Second straight weeks of declines. And I want to bring everyone's attention here to Monster Beverage and Boston Beer. We got some updates out of both of those companies, and not good. Monster Beverage still dealing with a lot of supply chain issues, particularly with regards to getting aluminum cans and the price of those cans. We actually heard this from Constellation Brands and its trouble in getting brown bottles. Monster Beverage shares down about 5% right now. Boston Beer dealing more with sales issues. Those shares down 10%. They gave an update here, and I thought a Credit Suisse analyst really put it best. This is the great seltzer reset, according to that particular analyst, but did say that this could be a clean slate for Boston Beer going forward, allow them to sort of rejigger their lineup and maybe get some new customers in the door.
That brave new world that White Claw brought us seems to be slightly coming undone. Meanwhile, this was another sign in the times, I thought. We all assumed that people were still spending plenty on e-commerce as we were looking towards the holiday season. The retail, the consumer was strong. But the retail sales for December really lackluster, down 1.9%, far off the estimates for basically flat to slightly lower. And this seems to be being blamed to a large extent that we will front run the supply chain issues that you see in Monster Beverage and that you see in Boston Beer. We wanted to get ahead of the curve in terms of our ordering for holiday gifting, but I'm still surprised by the weakness being shown by the U.S. consumer here.
Well, that's the optimistic take, right? That, maybe consumers planned ahead, did their spending early. The more pessimistic take would be that, maybe inflation, that rise in price pressures is keeping consumers on the sidelines. In any case, we did hear from President Biden's economic advisor, Heather Boushey. She joined David Weston live from the White House earlier today to talk about inflation. Here's what she had to say.
The cause of inflation, at its root, it remains that the cause of this has been this historic pandemic, which has upended life in so many different ways, and particularly has upended America's supply chains.
And that was Heather Boushey live from the White House, squarely placing the blame on all this inflation that we're seeing on supply chains, on the pandemic. And I mean, we're still living in that pandemic, and we're not in lockdowns in the U.S. That isn't the case around the globe. That's going to just stress out supply chains, and they're already pretty strong.
I appreciate the commentary, and there's no doubt there was a pull forward here. I mean, we talked about a lot of that. A lot of us sort of went out in September, October, started buying Christmas presents because we were so afraid we weren't going to get what we needed. But there are some other issues here, too. The idea that you had a lot of fiscal stimulus in this economy last year that helped a lot of people on the lower end of the spectrum continue to spend. That stimulus is not there any longer. You had a lot of other programs out there that also help people continue to spend. That now is also gone here. And I wonder how much you have to start looking at the programs coming out of the White House or the ones that they're not able to get out, and how much that's having an effect on retail spending.
And I think this is why the commentary coming from the C-suite right now is going to be so important as we unfold this earnings season, as we hear from the banks and their sort of confidence or lack thereof around a consumer. I mean, Shonali, at the moment, they are talking of a loans growth pickup. They are talking about people willing to, well, maybe return back to their credit card spending.
Yeah, and it's interesting because they are returning, but not at the pace that investors had expected. And certainly some of these issues could start to dampen that into the year and delay those successes even further. Guys, there are some bright spots to some of these supply chain issues as activity picks up to move supply chains. Bankers are making money off of that.
Yeah, they're making money off of that. There is a broader issue here, though, about inflation that we need to discuss. And I just want to bring to the attention for our viewers and our listeners here, the Netflix shares, which are in the red here, have actually spiked up about 3% here. We're getting a report. This appears to be from Reuters here, saying that Netflix is actually raising its prices in Canada. These are the monthly subscription prices. And Caroline, you were just talking about this idea of what we're going to hear out of these companies on these earnings calls. We want to look at what their margins are like, but what we really want to hear is how much pricing power do they have? Can they pass on some of the costs that they have to the consumer, and are they going to eat it? And we know Netflix, at least in the past, has shown that they do have that pricing power.
Particularly in the developed markets, US, Canada, where they're starting to have a much richer amount of production being made, but also the emerging markets, the developed nations. This is going to be such an important earnings that are going to come to us next week about how indeed Netflix continues to fight off some of the competition. It's also going to be a real bellwether for the reaction in the stock market for one of these big tech companies that has done so well throughout the pandemic, and now we question the valuation of.
The big tech company that had just been, I mean, to say that the stock had gone down, I was going to use a more colorful phrase here, but the stock has just gotten absolutely shellacked over the last 2 months here.
If you're paying more for Netflix, will you also continue to pay more for HBO and Hulu is the question to me.
Oh, you haven't met my family, have you?
I got all of them, but maybe I won't next year.
You guys are just popping them all up single-handedly, right?
I will just say I finally got a hold of my parents' HBO Max password, so I am not quite on board.
Did she just admit to a felony
right now?
live on the air here?
Imagine if it got canceled just because I disclosed that. But in this conversation about pricing power, I do feel like these retail sales that we got for December might be a troubling sign that maybe consumers are starting to push back a little bit. I mean, when we were heading into this earnings season, that was the conversation I was having with analysts, that you are starting to see sort of an inflection point among consumers. Yes, they've been very willing to absorb higher prices so far, but that music has got to stop sometime. Maybe it was in December.
All right, Katie Greifeld there doing the work of at least 2 people. I'm not sure.
I moved my mic a little bit.
Yeah, Tim and Carol taking a well-deserved day off. That does it for our little powwow here. We're going to be back together again live on TV, radio, and YouTube at 4 p.m. for our Beyond the Bell coverage when we take you through today's market close. All right, and for our audience on TV, we have...
All right, you've been listening to our cross-platform coverage with our TV colleagues. This is Bloomberg Business Week. Carol Master along with Katie Greifeld. Let's make sure we let Romaine know that I'm actually working, Katie.
You are. I know. I will make that very clear in about 53 minutes.
But you are doing the work for at least 2 people. No doubt about it. You're holding down the fort. We really appreciate it. Hey, I was listening, though, to your guys' coverage and just looking at Netflix, man, just popping on that headline. It's now up about 2.3%. And getting ready to share a message to my husband like, all right, let's get ready to pay more for Netflix, it looks like, huh?
Yeah. And I mean, it is interesting to see shares move higher than this. We'll see what the reception is among consumers. But yeah, Netflix really needs some legs because in 2021, shares up just over 11%. Carol, we know very well by now that the S&P 500 moved higher by 27% last year. So Netflix has been a relative underperformer when we're talking about some of those big tech companies that have been really leading markets.
I want to know what it means, like why they're raising prices at this point. And I'm also curious, especially coming off of that retail sales print for December. Big disappointment. I know we're talking about merchandise, right? Retail, the stuff that we can buy. But, you know, if we're all seeing, you know, maybe our wages go up, but they're not outpacing inflation, you know, there's just so much money in our wallet, maybe we won't be able to afford that increase in Netflix in terms of the subscription. Like, how will we ultimately allocate the money that we do have?
Yeah, and I mean, is this just a price increase to make more content, maybe that'll pay. If it's another Squid Games, maybe, but we'll see what happens, what they have planned.
All right. Well, right now, though, Netflix share is one of the gainers in today's session. Let's get back to world and national news. For that, it's Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. Americans were spending less last month with retail sales slumping by 1.9%. Bloomberg's Irv Chapman has more on today's report from the Commerce Department.
In part, it was the result of people starting their holiday shopping earlier in the fall for fear of shortages, but mostly it was the impact of Omicron. Dana Peterson, chief economist of the Conference Board, said in a Bloomberg interview.
Many people probably were just not out shopping because they were afraid of getting sick, or they were getting sick, in fact. But then the second quarter should pick up as we get beyond Omicron, and certainly as in-person services reopen and people can go out there and enjoy their lives.
Peterson said Conference Board surveys indicate Americans are still in the mood to spend money, including on hoped-for vacations. In Washington, Irv Chapman, Bloomberg Radio.
The Biden administration has selected Sarah Bloom Raskin to be the Fed's top banking regulator and tapped economists Lisa Cook and Philip Jefferson to serve as governors. Cook and Jefferson are both black. Heather Boucher with the Council of Economic Advisors tells Bloomberg all three are great choices.
For the first time, we'll really have an incredibly diverse slate of people serving at the Fed. It'll look more like America than any other Fed before, and that's a really exciting thing that is the outcome of these terrific three highly qualified candidates.
Boucher says all three have decades of experience. The man dubbed Pharma Bro, Martin Shkreli, has been banned for life from the drug industry and ordered to pay back $64.6 million in profit. A federal judge imposed the penalties on Shkreli for him famously inflating the price of the life-saving drug Daraprim. Global news 24 hours a day on air and on Bloomberg Quick Take.
All right, Nance, thank you so much. Nancy Lyons with the World and National News update out there in D.C. Katie, I'm just going to say, note to self, don't get a nickname Farmer Bro, and maybe you won't get into trouble.
Yeah, right? Yeah, I think Katie's a fine nickname. I'll try to stick with that for as long as possible.
Exactly. I make light, but I mean, serious stuff there, man. A story by our Allison Verspril on the Bloomberg terminal has to do with NFT investors owing billions in taxes. And guess what, Katie? IRS, they're on it.
Yeah, I mean, what a boom that we've seen in NFTs this year. That market now worth $44 billion. So you could see billions of dollars in taxes along with that, and rates as high as 37%. That's according to tax experts. And, you know, there's a great quote in the story that just because the IRS hasn't really provided guidance that might meet your expectations, that doesn't mean that you don't get to not pay taxes.
That's right. Just because they're still figuring it out doesn't mean the tax man doesn't come. The rules about taxing tokens, they're not clear. It leaves kind of the NFT collectors scrambling to calculate how much they owe. Investors may not realize they need to pay any taxes at all. Or that they should file at least more than once a year, increasing the odds that they'll face future penalties. So you got to know what's going on here because they're going to be coming for you.
Yeah, I mean, it is such a headache, both for, you know, the collectors here, the people who are buying NFTs, but also for the IRS. And of course, there's a lot of disagreement over, you know, how you actually tax an NFT. But you do have most tax experts agree that, you know, these profits, any profit that you do make on your NFT should be considered ordinary income. That's where that rate of 37% comes in. But obviously, there's a lot of disagreement over that, over what category actually those profits should be looked at as.
You know, it's interesting, too. Business Week has done a lot. I know all of Bloomberg News has done a lot. I mean, NFTs are invading so many different spaces, the fashion world, art certainly. And so there's a lot of rules that are still murky, and we're figuring it out. But everybody be aware, certainly if you're dealing with NFTs. You are listening to Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Less than 43 minutes until happy hour. I meant to say the closing bell. Let's get you the latest price action. We'll cross to the Bloomberg Macro Squawk Desk. Bill Maloney is there. Bill, what are you seeing?
And good afternoon, Doug. U.S. stocks trading mixed right now, but off session lows. The Dow is still down 294 points. S&P's dropped 10, while the NASDAQ is now higher by 30. The U.S. 10-year yield at 1.78%. Gold is down 5. Bitcoin is higher by 0.8%. And among the main 11 S&P sectors, leaders were energy and tech, while financials and real estate were in the red. Leaders to the upside in the Dow, Amgen and Chevron, while J.P. Morgan fell 6.6% after earnings and led to the downside. Also after earnings, Citigroup fell 1.2%, while Wells Fargo rose 3.4%. In other news, Netflix raised U.S. and Canadian monthly subscription rates, and Apple's VR headset launch risks being delayed until 2023. Wrapping things up, casino names soared on favorable Macau license renewal terms. Las Vegas Sands jumped 12%. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, and we have crude oil above 84 the barrel here in the electronic session. Oh, by the way, if you want to get live audio updates right on the Bloomberg terminal, the function is SQUA, then the green go key. 19 past the hour, that is your Bloomberg Business Flash.
You did say happy hour, right?
I did. You caught that. Bill didn't. Whatever.
He's a little slow. No, he's not a little slow. He's never
guy.
slow. It's been quite a day and a week. I'm ready with you, Doug. All right, take care. Well, we've talked a lot about the increasing legitimization of cryptocurrencies. We've seen that, Katie, safe to say, in a big way this past year, whether it's governments, officials, companies, you name it. Our next guest lived in Africa and Latin America for over a decade, worked on building out mobile payment platforms. She is former CIO of emerging tech over at GE Digital. Today, she's the founder and CEO of O Group. We are delighted to bring in with us Maya Vujinovic. She joins us on the phone in Miami. Maya, nice to have you here with Katie and myself, and I hope I got your name right.
Oh, absolutely. It's such a pleasure to be on, and Happy New Year to both of you.
Well, Happy New Year as well. Tell us a little bit about your background, because I think, you know, Katie and I, we watch the established financial guys kind of playing catch up now with the crypto world, and for a long time they shunned it. It does feel like, you know, the emerging markets and disruption innovators, those folks were really ahead of the curve. Your experience in the emerging market world, how does that give you maybe a different perspective when it comes to the world of cryptocurrencies?
That's an on-point question and a very relevant one to what we are seeing today. When I started off in early 2000s, I went on to do payments in Africa, and then Latin America followed. That was at the same time when M-Pesa was starting. And now you're seeing this incredible reversal where actually Africa is leading in adoption of cryptocurrencies, even comparison to North America. So the perspective is absolutely different in the sense that I've lived there, I have paid employees, I've received my own salary in these things. And when you realize that the amount of money that it takes to actually pay the banking fees and cross-border payments and the difficulty of doing all of that, this is where I had my light bulb moment about Bitcoin. And when I received the Bitcoin white paper, I thought, if this happens, this will be unbelievable. And that was in 2009 and 10. So I have lived it. We've built some of these platforms in emerging markets. And when you actually see the amount of money that it takes and the difficulty for people to launch businesses, for people to get paid, for people to transfer money to their dear ones, it is absolutely an incredible solution, and no surprise that it's gaining such traction in emerging markets.
And Maya, when we talk about emerging markets, where do you see the most potential to integrate crypto when we talk about the different countries?
Yeah, sure. I think that's also an excellent question in the sense that there is a bit of a divergence. And what I mean by that is you will see regulation in some of these emerging markets really clamp down on crypto. We've seen it in Nigeria. We've seen it in Zimbabwe. We have seen it in some of the Latin American countries as well. But if you look at Brazil, if you look at Argentina, if you look at Venezuela, these are all countries where the currency, the local currency fluctuates tremendously. And if you look at apps like, for example, Reserve, that is a stable coin that is mainly in Venezuela, but across Latin America, it's currently being used. I think about $60 million of transactions monthly volume is being used currently to keep the stability of Bolivar while the currency fluctuates, or depending on what happens with the US dollar, right? In Africa, you're seeing a huge potential because obviously if you look at Nigeria, for example, right, which is the most populous country in Africa, it is full of extremely impatient youth that is hungry for innovation. And when the oil supply goes down, right, and the dollar is actually, the dollar supply is squeezed out, many of the businesses are simply unable to pay foreign suppliers and lenders, right? And so this becomes a really big use case for countries like that as well.
Yeah, and let's dig into some of those use cases because, I mean, crypto, it's such a broad umbrella. People usually think just Bitcoin, but I mean, we start thinking about cross-border payments, stable coins. I mean, what are some of the biggies here?
Yeah, absolutely. So one of them that one simply can just be access to earning money, right, in a different way, and access to some kind of a financial freedom. Yes, it comes with risk, because it is not regulated, it has huge fluctuations. So one could be just a massive umbrella, access to ability to earn money besides what your government is offering you. So you could, for example, there's another platform that is being launched very soon. It's called Toucan. It is a nature-based carbon token, right, that is linked to a verified carbon credit market, and it connects crypto capital to kind of a planet positive projects around the world. What does this mean for emerging markets? Suddenly, Katie, means that folks can access a fractionalized version of a carbon market that is usually very tainted, that is only available to those that actually have a lot of money. It's a democratization of assets, right? And so you can now buy into something that you believe in, not just what your government or what the local news might be offering to you. So that's another example. You could end up using some of the crypto and lending against your crypto for a local currency to go and then take money for your local business, right?
Right.
It offers a plethora of opportunities for people to do that.
Maya, you are full of information. You've got to come back and share some more with us because your perspective is obviously unique, especially when it comes to all your time you've spent in emerging markets. So we hope you do come back. Maya Vujinovic, she is the founder and CEO of OGRIP, joining us on the phone in Miami. All right, you are listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
And you are listening to Bloomberg Business Week. Carol Masser along with Katie Greifeld. She's back in our Interactive Brokers studio. And Katie, we got a retail sales number read. Yesterday we talked about the price of lettuce. I mean, food in particular has really gone just kind of off the charts.
It really has. Carol, I will tell you, I paid $10.56 at Starbucks this morning for a coffee and an egg sandwich, just 2 items. Can you believe it? Definitely feels like some inflation there, but it is, a very serious issue because it's food. It's not like it's a cost you can defer. You have to pay for it.
Yeah, certainly not a discretionary when it comes to spending. All right, we're going to get more in the chart of the day with Kriti Gupta. She is looking at those high food prices. In the meantime, let's get back to the markets and a look at your trading day. Just about 28 minutes to go, Doug Krisner.
Yeah, you're right, Carol. But that's a great segue, or this will be, I hope, because today we heard from New York Fed Bank President John Williams. He was saying inflation is too high, particularly at Starbucks. No, I'm just kidding. And the Fed has got to work to bring it down back to that 2% target. We also heard from the CEO of J.P. Morgan Chase, Jamie Dimon. He told analysts, in his view, there's a pretty good chance the Fed will be hiking rates more than 4 times this year. He could see maybe 6, possibly 7 rate increases. Now, speaking of J.P. Morgan, the bank, along with its rival Citigroup, each posted steeper than expected drops in trading revenue today. So we're seeing the financials down today. The S&P Financial Group weaker by 1.3%, even though we are seeing much elevated long-term interest rates. 10-year Treasury now at 178. Dow Industrial Average down 0.7%. We have the S&P weaker by just 0.1%, and a recovery in information technology leading the NASDAQ comp higher by about 0.5%. What a curious bifurcation. It's not even a bifurcation. That infotech is moving kind of in lockstep with the bond market where we have a spike in rates. I can't make sense of this anymore. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much, Doug. Let's get now to Kriti Gupta. She is our Bloomberg Markets correspondent. Joining us now on the phone from our New York City bureau. She is here with her chart of the day. Kriti, what are you looking at?
Well, we got to talk about food prices, Katie, because I don't know if you've looked at your grocery bill lately, but I have, and it is getting higher and higher. So that's really what my chart of the day kind of highlights, the idea that food prices have been rising, not just here in the United States, but around the world. But it's the margin that really caught my eye, the idea that food prices are at the highest since back to 2011, essentially telling you that the acceleration of food prices has been really strong. Now, I just kind of want to quickly point out what actually happened in 2011. Natural disasters, civil wars, crop fires in Russia. You had droughts in the United States. The United States and Russia are the 2 biggest kind of wheat and grain producers. So to see that kind of acceleration mirror what you're seeing right now really tells you just how dire kind of the move in food prices has been. So that's my chart of the day.
All right, we'll talk about that chart a little bit more. I mean, in terms of, I think about our audience, what they need to be aware of it. And obviously our folks can see it on YouTube, but for radio, we always love when you can dig into it a little bit more.
Yeah, absolutely. Well, so what we're seeing in the food price space, I mean, if you kind of speak to your average American, they're probably going to agree that your grocery prices or your grocery bill is getting just a little bit more expensive. Perhaps restaurant prices are getting more expensive. Or if you have your food delivered, those delivery expenses are increasing as well. But if you kind of macro this out, really zoom out, look at the world, and this is why you looked at global food prices instead of just the United States, food prices have actually been driving global inflation. So if you look at someone in Cambodia, and someone in Mexico, someone on the African subcontinent, that impact is much, much larger. And it's actually that kind of move that's creating a lot of these rate hikes, not only in emerging markets, but now here in the United States and in developed markets as well, because they're saying, well, one of the major drivers, it's not just energy, even though gasoline gets all the credit for that, it's also food prices.
And it's interesting, Kriti, that a lot of this doesn't feel like something that monetary policy can fix. That a Fed rate hike, I mean, is that going to stop there being a drought in the U.S. or a fire in Russia? I mean, this feels almost like, what even could Jerome Powell do?
Yeah, well, it all kind of trickles down, right? Because it ends up coming back to the people who are actually in this. So if you increase rates and you're actually targeting some of those higher inflationary numbers, it trickles down to, say, your average grocery store or companies that are now borrowing at rates or are having to kind of adjust how much their costs are kind of eating into their bottom line to adjust how much they're charging to consumers. So let me just give you an example here. Albertsons, for example, reported earnings this week, and they actually said that one of the reasons that they weren't able to beat their earnings was because of the expenses that are associated with getting fresh produce. Now, why is fresh produce becoming kind of this sticking point? Well, it's because there's even more demand for it in a way that they've never seen, so they've had to adjust for it.
Creedy, what I'm confused about is if we're talking about inflation because companies are raising prices, we're talking about lettuce being up 60% from a year ago. Are you telling me, are we hearing from companies that they're not raising prices enough to cover all of their increased costs? They're still giving consumers a break, even though we've seen a big jump in prices? Because I guess trying to get to the heart of, are all of a company's costs being passed along, or they're eating some of it as well? Because some of the jumps that we've seen in things are off the charts.
Yeah, well, they are eating some of it. There's no doubt about that, because you are seeing it affect some of their margins. Some of those margins for grocers aren't as strong as the margins for your average tech company, for example. So
but they're never strong, right? In a supermarket, they've never been strong.
They haven't, but they have been in terms of this last year, because margins as a whole for all kind of companies have risen because of this fiscal stimulus. That being said, it hasn't risen enough. So what they're kind of grappling with is, on the one hand, you want to make sure you're able to meet your bottom line, but you don't want to raise prices too much to the point that people don't buy the produce anymore, because that would be the consumer pain threshold. So it's finding that balance, and in that, to kind of prevent that demand destruction, they are eating some of the costs, but also passing some of it along.
And Curdy, we have just about a minute left, but I know you're also keeping an eye on casino stocks.
Yeah, casino stocks getting a little bit of a break today. Las Vegas Sands, Wynn Resorts, all higher on the day, coming after a Macau license renewal. They're actually saying that some of that regulatory scrutiny that they were worried about is not going to be as strong as was expected, and it's actually boosting some of these casino stocks that get most of their revenue from Macau.
Interesting stuff. Watching them and interesting to see an outperformer there. Kriti, thank you so much. Kriti Gupta, she's Bloomberg Markets correspondent, there with her chart of the day and also those casino stocks that she's keeping an eye on. I should point out a little bit of a plug in the Bloomberg Business Week issue, the year ahead. They take a look at Macau specifically and what's going on. Katie, that's been a big growth area for a lot of these gambling companies, particularly those in the U.S. and elsewhere.
Oh, big time, which is why you saw so much anxiety in that sector in particular when you did have those fears about Macau really, tightening those rules. Huge relief rally today. I mean, Las Vegas Sands, Wynn Resorts, those are your top performers in the S&P 500 right now.
Yeah, so fascinating to see that. All right, folks, we're just about 20 minutes away from the closing bell. In the meantime, let's get you caught up to speed on world and national news. Over to Nancy Lyons once again in D.C. Hey, Nance.
Thanks, Carol. After legislative and legal roadblocks in recent days, President Biden is focusing on the billions of dollars in infrastructure spending that his administration did have approved last November. He says it's now being distributed to fix roads and bridges, replace lead pipes, and to help provide high-speed internet to every family in America.
This bipartisan infrastructure law I signed 2 months ago unites us around things we all depend on.
Biden says he doesn't want to talk about disappointment in things they haven't gotten done, because he says he's hopeful some of it will still get done. The Commerce Department says retail sales sank 1.9% last month, with Americans cutting their spending in the face of product shortages, rising prices, and the onset of the Omicron variant. But one product Americans are still buying: alcohol.
The combination of travel bans, lockdowns, school closures, and canceled family gatherings brought on by the global pandemic was enough to drive a person to drink. And with bars, restaurants, and sporting venues often closed or restricted, consumers had to find new ways to get one. Off-premise sales of alcohol soared after March 2020, and the trend is expected to continue. Officials at Payment Processor Square tell Bloomberg that it's more important than ever for food and beverage providers to meet customers where they feel comfortable, including curbside, in-store, or via delivery. In Washington, Ann Cates, Bloomberg Radio.
A House Republican who voted to impeach former President Trump for inciting the Capitol riot has decided not to run for re-election. New York's John Katko says he will not seek another term. He says his perspective on life has changed and he'll now be able to spend more time with family. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in the nation's capital. Carol Master along with Katie Greifeld here on Bloomberg Business Week on Bloomberg Radio. And Katie, we spend a lot of time, I'm guessing you guys do too, at Quick Take, just tracking what's going on with Cathie Wood and ARK Invest. They have a handful of funds. Their ARK Innovation has been their big one. And for many years, we saw, billions of dollars flowing in. But really since about February 12th, I think of 2021, it hit a high. It's now down about 49% since. And we've seen certainly the net assets really come down.
Yeah, and it's even though, like you said, since, last February, you've seen this big drawdown, those assets that flowed in during 2020, a year when that fund was up 150%, they stuck around for a long time. But you are starting to see the mood music shift a little bit as just the performance numbers can't seem to get off the ground. This story looks at flows from this week. You saw investors pull $352 million from ARK KK. That's the biggest fund. That outflow was on Wednesday. Carol, that is the third biggest outflow on record for this fund, and we'll see if there's more to come, but that was definitely a big hit.
Yeah, that's a big hit. Here's a little bit more perspective. The flow is still small, or while the flow is small compared to ARK assets overall, its 9 ETFs still boast about $25 billion. It does mark a potential turning point for an investor base that until now has barely wavered in its support for Wood and the firm that she founded back in 2014. Her outflow, as you said, Katie, third biggest on record. The last time the fund lost over $300 million, it was trading 44% higher. Our Sam Potter and Denitsa Tsikova writing this story on the Bloomberg, and I'm reading from it. Hard to say. We've seen some volatility in our fund, and we know right now that, investors are running from some of those high flyers.
Absolutely. Unfortunately, for better or worse, her fund has really become synonymous with some of these speculative tech companies. High growth, potential high reward, but a lot of risk, and you're seeing that just in the past couple of weeks.
Yeah, no doubt about it. All right, you're listening to Bloomberg Business Week. Carol Master, Katie Greifeld, and you are listening to Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We have less than 13 minutes until the closing bell, and talk about resilience. The S&P is fighting to get back to its best level of the day. The index down just about 0.1% right now. We are seeing a recovery in information tech, and along with strength in energy shares, we've got the NASDAQ composite rising by about 0.4%. But many of those economically sensitive names like financials and real estate moving lower. The Dow is down right now about 0.7%. We had some weak economic news today, or at least disappointing economic news. Retail sales down in December by the most in 10 months, and growth in U.S. factory output unexpectedly declined. Both of these data points have, as a part of the narrative, concern about inflation. When it comes to the consumer, maybe surging prices are having a negative impact. And then when you consider industrial production, persistent struggles with both material and labor shortages are getting a blame. Now, in spite of some of these mediocre readings, we have a big spike in long-term interest rates today. The 10-year Treasury is up 8 basis points, 1.78%. A lot of the conversation today has been around the urgency of the Fed needing to hike interest rates. We heard today from the head of the New York Fed Bank, John Williams, saying inflation is too high and the Fed will have to work to bring it back down to that 2% target. And then the CEO of JP Chase, Jamie Dimon, was saying there's a pretty good chance we're going to have more than 4 Fed rate hikes this year. It could be 6, maybe even 7. I'm Doug Prisner. That is your Bloomberg Business Flash.
It feels like the number keeps growing and growing. All right, Doug, thank you so much. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Temperatures in Alaska reached record highs in recent weeks, while researchers warned that a major ice shelf in Antarctica could collapse in just a few years' time. These are signposts on a grim path. They show that damage to the cryosphere, the portions of Earth's surface where ice predominates, is happening faster than many people expected. Unfortunately, melting glaciers and thawing permafrost themselves worsen climate change, creating terrible feedback loops. After a year of climate promises, 2022 must be a year of action, particularly in the Arctic and the Antarctic. Cutting global emissions is, of course, essential, but policymakers should also investigate large-scale technological interventions that could help slow runaway warming at the world's poles. Such efforts could at least weaken those feedback loops and buy crucial time for emissions reductions to take hold. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, let's get to it. We've got just about 10 minutes left in today's trading session, getting ready to wrap up another wild week here in 2022, 2 weeks in. But we are near our best levels for the most part on our major equity averages. Carol Master along with Katie Greifeld. Let's bring in our guest, Darrell Crate, Chairman and Managing Principal at Easterly Investment Partners. He joins us on the phone from Massachusetts. Darrell, how are you?
Oh, I'm well today, thanks. How about you guys?
Doing okay, trying to, just watch the economic news, the Fed speakers, a lot going on. It does feel like markets are a lot more nervous than they were perhaps even at the end of 2021. Fundamentally, how do the markets look to you?
Yeah, I think what we're seeing is this fundamental transition from growth stocks to value stocks as people fear the Fed. This is beginning a theme that we're going to see probably for the next year or two. The 40-year bull party for bonds is over. Jerome Powell has turned the lights up, and he's asking everybody to leave. With very low rates, investors are discounting earnings that are 20 years out in today's growth valuations, and we're seeing a shift to value.
And why should we believe that this shift to value? Because, we've seen some runs at this rotation a few times in the past 2 years or so. What makes this time different? Why would value stick around this time?
Oh, it's a great question. And what is different this time is that we're going to see 3, 4, 5, 6 rate hikes, over this next year. And what you saw in 2017, 18, 19, as the Fed took interest rates to zero, earnings for growth stocks were discounting earnings that were, again, 15 or 20 years out, that were significant. And as those rate hikes go up, what you're going to see is those growth stock valuations declining, and that's going to have a permanent effect on the market.
So at this point, what would you recommend to investors that they do at this point? Because there's still a lot of questions out there, right? Safe to say, we don't have the playbook for exactly how we come out of this easily. Our Eric Schatzker catching up with Dr. Kaufman, and really nervous about that we don't necessarily have a Fed out there right now, led by Jay Powell, that's going to maybe make the uncomfortable, aggressive moves that we need to really rein in inflation.
Yeah, I think you're right on it, which is, our fear is that they don't move fast enough, and there's also a fear that they're going to overreact. So, today, coming out of the pandemic, supply and demand imbalances are the source of the greatest risk. They're the driver of both this real and transitory inflation, and how the Fed reacts is going to change the amount of liquidity in the economy through consumer purchasing power as well as the supply of credit. I think the recent good news we see is that Senators Sinema and Manchin have decided to be the designated drivers in Congress, and they're going to prevent officials from throwing more gas on the fire while the Fed is trying to get it under control and get us back to a time of great price stability.
I'd love to talk a little bit about that dynamic between fiscal and monetary policy, because, with all those rounds of stimulus that we saw, fiscal policy maybe it wasn't in charge, in 2020 and 2021, but definitely had a big role to play. But at this point, do you think that monetary policy is really the dominant factor driving markets at this point?
Well, I think all of these things work together, to create an economy. For the last 20, 30 years pre-pandemic, the economy became more and more refined with just-in-time processing, these very complicated supply chains that were able to meet demand in an instant. And the pandemic just threw everything afoul. So we need proper fiscal policy, we need monetary policy, and we just need the economy to get going. We need this pandemic to end. I think that seems like we are getting near with Omicron. If you look at, we watch closely the RNA factor in wastewater in large metropolitan areas, and that in the last 2 days has declined materially. So, as we see over the next week or two, that's going to work its way into the system, and we're going to get to hopefully what is a new equilibrium.
We've heard a lot from various Fed officials and other market watchers, Daryl, about the difficulty, though, of the Fed right now in terms of threading the needle and not making a policy misstep that leads us into a slowdown in growth. Is that likely? Do you think about a recession potentially next year, or maybe getting into 2023?
I think if there's certainly an overreaction will cause recession. I think today that's why finding companies with strong balance sheets, that are favored in this market environment are really the way for equity investors to play this period. As we look at these fourth quarter earnings and see how this is going to come together, I think material stocks and consumer discretionary stocks are going to do well. In Q4, buyers wanted what they wanted, and when they saw it, they bought it. Markdowns for consumers that we've grown used to in the past, we didn't see it. So looking at stocks today like Kohl's is a great place for investors to look, as well as anything that's selling into the home. That's continued to be strong. Companies like Mohawk Carpet.
And Daryl, what don't you like right now when it comes to the markets?
I think you've got to be careful around banks. We're going to see. We saw some surprises this morning, but as you look forward, their ability to retain talent is going to be difficult. You see these large money center banks that work in large cities have had a real workforce issue, And as inflation is here, we all see it in the grocery store every day, paying 10, 15, 20% more for chicken, meats, the things that are on our table. You're going to see wage inflation, at these institutions that's 7 or 8%. They have not dealt with that in many, many, many years. So, their margins are going to be under pressure, notwithstanding that a yield curve is good for banks.
Right.
But you look at companies like Western Alliance,
right.
Who are trying to reinvent themselves in a way, to address the new digital economy, which will help them.
All right. Really appreciate your time today. Daryl Crate, Chairman and Managing Principal of Easterly Investment Partners, on the phone from Massachusetts. I'm at home. I'm going to be listening closely for what's coming up next. Katie's going to be joined by our TV team for Beyond the Bell on radio, TV, and YouTube, counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Shanali Bassick in for Taylor Riggs on assignment. Counting you down to the closing bell. And here to help take us beyond the bell, it's our global simulcast, joined right now by Katie Greifeld, who's out there stealing passwords to her parents' Netflix. But for the moment here, we're going to talk about what's going on in the market. And Katie, look, we got a little bit of a turnaround here as we get to the close here. I mean, we talk a lot all week long about what's the threshold where you start to see those dip buyers come back in. And we've seen it a couple times this week.
We saw it a couple times this week. We saw it today. The S&P 500, it was down by as much as 1% at one point. Finishing the day looks like a 10th higher. Such a comeback. Even the ARK Innovation ETF, sort of the proxy for all those speculative areas of tech, also finishing the day higher. NASDAQ 100, 0.8%. Just really an incredible rebound.
Katie, a rebound in Doge. What did you make of that?
Thank you, Elon Musk. Thank you. He can't stop tweeting about it.
I mean, he can never stop teaching about any of these sorts of things. But really, the story of the day I completely digress from is actually the banks, Shanali.
Yeah, absolutely, because you have the biggest one in the United States, JP Morgan, really leading the index lower and the financials lower overall over here. We do have most of the S&P still in the red, but we do have some bright spots still, too.
And we should point out with bank stocks, I mean, we had seen a pretty strong rally heading into this week and really heading into this day. I mean, bank stocks still higher, at least as a group here on the week here. And then we got, of course, next week, Goldman and a few other banks, Morgan Stanley, Bank of America, as well as now some of those second-tier banks. And it'll be interesting to see what they say going forward and how it stacks up against, I guess, some of the more measured commentary that we got out of Sir Jamie Dimon. There's your closing bells here in New York. The Dow Jones Industrial Average is going to stay in the red here. One of the outliers, down about 0.5% or so as we wait for these numbers to settle officially. But it is going to be a down day for the Dow Jones Industrial Average. It's going to be a down week for the Dow as well by about 0.8%. The S&P 500 looks like it's going to finish in the green by just about 0.8%. Lower on the week by about 0.3%. The NASDAQ Composite higher on the day by about 0.6% and lower on the week by about 0.3%. And the Russell 2000, which I think this is interesting here, managed to actually poke into the green here. We talk about some of those value names and some of those cyclical names that have been lagging, up about 0.1% here on the day. Still down on the week, though.
Yeah, there you go. I mean, yeah, it's been interesting to see small caps kind of miss out on some of the dip buying action, clearly participating today. I just want to point out the S&P 500, that big rebound we saw, that was with 7 sectors in the red. I don't want to steal anyone's thunder, but not a huge amount of breath.
Yeah, and we should just point out, too, that did seem to be a correlation between that rebound we saw on Netflix and the S&P taking a leg higher.
Yeah, let's talk about those sectors a little bit here because financials, yes, they're in the red, but not as much as real estate ended the day. We saw that a little bit lower. Then we saw the financials drop, so the financial cover just a little bit. Energy, the big winner here on the day, 2.4% higher, followed by Infotech, had a little lift as well today. So again, guys, not everything in the red there.
Not everything in the red. I'm going to do gainers and decliners. Also, I have notes from Carol Masters. She wants you to know she is working today. She's just from home. But in any case, let's look at some of those movers. We have Las Vegas Sands. It is your biggest gainer in the S&P 500, higher by 14% today. It was just one of many casino stocks staging a relief rally. That's, of course, after Macau's changes to local licensing rules. Not as harsh as feared. Biggest rally since November 2020. Netflix, we know, jumping just in the past hour after a headline that it's raising the cost of those monthly subscriptions in the U.S. and Canada. It looks like traders think that subscribers will be happy to pay up because Netflix shares closing about 1.3% higher. That's the good news. Let's get to the bad news. JP Morgan, again, we all know the story. Just one of several banks reporting today. They have some big spending plans Traders not too thrilled about it. You saw JP Morgan close lower by over 6%. Just want to end on Home Depot because it was just one of the casualties that we saw out of that December retail sales report. Retail stocks broadly lower today. Home Depot, one of the biggest losers in that sector, shares down nearly 4%. That's the worst day since
Did
August.
Carol give you all these notes for these? She must have good
I have a
internet
few
connection
others
out on
that I
yacht.
could run through, but I'll keep a lid on it.
Meanwhile, though, I mean, I love that you focus in on that retail story because it's interesting that on the day that we actually got slightly weaker data than many had been anticipating, we're still all focused on what the Federal Reserve is going to do. We're still seeing this whiplash effect in the market where you see yields surge higher, and on the back of that, the dollar surges higher. This is why you've got an entire vertical of red in terms of FX, everything lower versus the US dollar on the day. Swedish krona down by a percentage point, then Aussie dollar also off by 0.9%. We've seen, of course, pressure in some of those commodity-related FX pairs on the downside. The New Zealand dollar, the Kiwi off by 0.8%. This is we see some of the love taken out of the metals prices. Copper was on the downside. Gold actually lost a little bit of its sparkle on the last day of trade. This is we sort of reassess what some of the data means and some of the strength of the US economy, particularly when you get that poor reading for December retail sales. Nevertheless, we did see crude oil still pushing up. We're having really on a tear at the moment for the month of January for oil. We're up 2.5% on crude. $84 is currently where we trade in that particular part of the market. Brent crude up 2.3%, $86. Of course, there's also been the pressure within the gas market as we see, well, the cold weather strike here in the Northeast. Once again, prepare yourself this weekend. But this is the story for me today. This is, even as we see banks get crushed on the day because of their individual earnings, this is a story of yields still spiking across the curve, but the US in seeing them in 2 year. But I wanted to show that this is a global story. Yields push higher in Japan, in France, in the Netherlands. Interesting move in the yen in terms of perhaps a more hawkish BOJ as well, Romain.
Yeah, you got a German 10-year yield actually threatening to go positive. You know, it's a new day out there. And Taylor, for some reason, decided to take the day off. So I'm going to do yields for her here. And you take a look at where we are here. The big move, of course, was on that 2-year yield, about 10 basis points higher this week from where we were at the end of last week, 97 basis points. The 10-year yield was basically kind of unchanged here, though there was a lot of ructions. Remember, at one point, we were above 180 basis points. And it was an interesting flattening that we saw in the yield curve, guys. I mean, you talk about that 5-year 30 down now at around 56 basis points, and that 210 curve down around 81 basis points. And that's maybe some of the concern you're seeing, too, as well with regards to some of the banks and the financials here, that the steepening, which will obviously eventually come, but at least for the moment now, is not there, and that might be causing a little bit of concern.
Yeah, exactly. We are seeing what that signals in terms of, is this the monetary policy acting too swiftly? Is it the fact that, well, yes, we'll tackle inflation, but you're actually going to stifle growth in the United States going forward, particularly when you start to see some of that weakening retail sales data that we saw today? I mean, I'm still potentially a little bit more unnerved by the lack of spending that happened in December in that particular department because of inflation.
A completely valid point, and the flattening of the yield curve, I've been talking about it all week because that is such a big deal. The banks are very sensitive to it. JP Morgan said exactly how much. It could be in the billions of dollars. And, you know, there's also this idea of, is there faith in the Federal Reserve to control that long end of that curve?
Well, just real quickly on the Federal Reserve, because, I mean, we talk about the language that we've been hearing out of the Fed members here, and it has been pretty much unambiguous that they plan at least to seriously discuss, if not necessarily hike, at that March meeting here. So you talk about comments out of Mary Daly this week, Harker, of course, Lael Brainerd. We talk about Loretta Mester, the interview that Michael McKee had, and of course James Bullard talking about potentially 4 hikes here. Raphael Bostic, pretty much everyone out there, even Neil Kashkari, the so-called Dove here. They've all made it clear now that this is their focus heading into that March meeting, and that means January meeting, January 26th. As Mike McKee said, maybe that's when we get the roadmap.
Now, is it a bumpy ride or not is the big question.
And we have earnings next week, Katie.
We do have earnings. It's going to be interesting. We have Netflix, obviously a big topic today. We also have the airlines, American Airlines, United. We heard from Delta this week. They see a path to profitability as soon as March. It's going to be really interesting to hear whether the other airlines think so as well, and also to hear from executives about how travel has been affected and this latest wave of Omicron, what the expectation is. Obviously, those executives really trying to sound optimistic, but it's hard.
And we may get really mixed results across industries. The banks were pretty sanguine about Omicron, but at the end of the day, that might not be the same for some of the airlines.
And keep an eye on some of the names here. I mean, for our radio audience, I mean, Goldman Sachs, of course, but J.B. Hunt, a big trunking company, we're going to hear from them. P&G, we talk about the ability ability to pass on the cost to the consumers. If you're in the sort of those lower margin products, how much wiggle room do you really have there? We're going to get those earnings on the 19th. I believe that's Wednesday. And then United Healthcare. Focus on the healthcare stocks, which have really been under pressure here for the last couple of weeks.
And how much are all of these companies seeing their expenses rise because of labor costs as well?
Yes.
How much is there this war on talent that we hear being voiced across the banking sector? But this is going to be a cross-industry issue that they're having to pay more for the people who work.
And they're just throwing out bonuses around the way. We just got blankets and cups around here. You know how much that must have cost?
Yeah, you know, how long does it last for is the other end of things. JP Morgan said this could last
I like my cup, by the way. You know they're all the same color, though.
Do you like it more than
so
a
everyone?
Okay,
so you don't
I
know. You
didn't
pick up
get
someone else's
the
cup.
Wasn't it nice? It was like a nice Yeti mug. I didn't get
It was
one.
very expensive. It was Yeti. Yeah.
My Yeti mug is not as big as my husband's Yeti mug, given by his company, so it's got very competitive in our household.
Okay.
Oh, middle-class woes.
Are you middle class?
Yes, clawing onto it, as I hope. Meanwhile, we're going to end this conversation, sadly, friends. Katie, always great to catch up with you. We're going to keep on rolling as we look towards the end of our cross-platform coverage on Markets Close with Bloomberg Television, Radio, and YouTube. Back Tuesday. Go have a great long weekend, friends. Meanwhile, see you same time, same place on Tuesday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Of course, Katie catching up with our TV team for our cross-platform coverage, wrapping up another crazy week, interesting week in the financial markets, and lots more to come. Did you really not get a blanket and a cup?
No, I didn't. I'm so salty about it. You know who texted me a photo of his swag?
Who?
Tim Stenovic. Can you believe it? I was very salty about it.
Oh my gosh, we got to work on that.
I know. I need to file a ticket. I need to just
Good
raise
luck
some
with that one.
ruckus. Yeah.
What are your thoughts? What are your takeaways from the week?
I mean, what a weird week in market. It feels like the narrative switches every single day. I mean, you could say that really any period on Wall Street in the financial markets, but I mean, just in the first two trading weeks, 2022, it feels like it's been especially disjointed.
Yeah, you do wonder, how much do we read? Is this just a sign of more to come, or we got to see how it all plays out? All right, Katie Greifeld, Carol Masser here on Bloomberg Business Week. Let's get back to World and National News. Nancy Lyons standing by in our 991 newsroom in Washington, D.C. Hi, Nance.
Thanks, Carol. Standing in front of a montage of photos of rickety bridges, today President Biden announced the first $5.5 billion of infrastructure money is being dispersed for the year ahead.
The president said tens of billions are going out to improve ports, airports, water supplies, high-speed broadband, as well as bridges.
My bipartisan infrastructure law includes the largest investment in our nation's bridges since the creation of the interstate highway system. Across our country right now, there are 45,000 bridges, 45,000 that are in poor condition in all 50 states.
The president said about a third of the money will rebuild crucial bridges that are part of the interstate highway system. The rest for local bridges, for which towns and counties will no longer be required to share the cost. In Washington, Irv Chapman, Bloomberg Radio.
U.S. intelligence officials are concerned Russia could be in the beginning stages of fabricating a pretext on state and social media to justify invading its neighbor Ukraine in the coming weeks. White House Press Secretary Jen Psaki says after a week of talking with Russian officials, the U.S. is ready for any outcome.
If they decide they're going to invade Ukraine, there are going to be economic consequences that go far beyond 2014. If they decide they want to engage in diplomatic conversations and talks, we are very open to that, and we're hopeful they will do that.
Psaki says intelligence operatives believe Russia could be sending saboteurs into eastern Ukraine. Well, as tensions build with Russia, Ukraine says it has experienced its worst cyber attack in 4 years. Officials say 70 government agencies were hit. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. You are listening to Bloomberg Business Week. Carol Masser along with Katie Greifeld and Katie, excuse me. I keep doing that because I've worked with Katie this week, and forgive me, my
It's
brain.
okay. I've been called worse.
Katie Greifeld in our Interactive Brokers studio. We're getting ready to talk with our Tim O'Brien. He's one of our opinion columnists, because something that I've really kind of wanted to dig into, and with help from our producer, Paul Brennan, just this idea of stock ownership when it comes to lawmakers. And kind of along those lines, you know, politicians, man, they're often having to explain some of their actions, apologize, and we certainly saw that across the pond.
Oh, yeah, definitely. Got to talk about Boris Johnson here. We have a story on the terminal today. This is a tough first sentence. I'm going to read it. Boris Johnson's office apologized to Queen Elizabeth II following revelations of partying in Downing Street the night before her husband's funeral. That's just adding further pressure on the Prime Minister. There's just been so much uproar over the fact that there's been a lot of pandemic rulemaking. I don't know if we're supposed to be having big get-togethers, big parties right now.
Yeah, well, well, it's tough when like an official comes out and says, please, stay home, don't do this, don't do that, during COVID. And then all of a sudden, there's somebody either on social or I don't know, showing that official in a party or something. It's not a good thing. This, though, the Daily Telegraph today saying on April 16, 2021, 2 parties were held in Downing Street to mark the departures of 2 staffers. That was on the eve of Prince Philip's funeral. One of them was Johnson's former spokesman, James Slack. At the time, indoor mixing between households was still banned, right? It's like, come on, the rules apply to everybody, right?
I know. And you did see the Prime Minister try to backtrack, explain himself a little bit, saying that he said that he thought that this House of Commons event, he thought it was a work event. It has since been uncovered that it was not a work event, but he did try to justify it.
Yeah, I know. And I guess we're all figuring our way through, but still. All right, you're listening to Bloomberg Business Week. Carol Massar along with Katie Greifeld, and this is Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It was a mixed day for the equity market. On the positive side, we had relative strength in energy and information tech. Those stocks advanced. However, we had economically sensitive shares like financials and real estate moving lower. I want to point out, too, that we had some disappointing economic news. That's kind of how we began the day. Retail sales in the month of December sank by the most in 10 months. It suggests that the surging prices now have shown up and are really taking a greater toll on consumers. And at the same time, growth in U.S. factory output unexpectedly declined. It seems persistent struggles with material and labor shortages are getting the blame. And I point that out because today, coincidentally, Sherwin-Williams was saying that staffing shortages combined with challenges with raw material availability will force quarterly results to miss expectations. We had Sherwin-Williams shares down 2.8% today. Dow Industrial Average down 0.6%, but in the broader market, the S&P managed to gain 0.1%. We had the NASDAQ comp rising about 0.6%. Interesting move in yield today with the 10-year Treasury rising 8 basis points. We were last quoted in New York at 1.78%, and a big day for WTI crude oil, trading above 84 the barrel now in the electronic session. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. You are listening to Bloomberg Business Week on this Friday. Carol Massar along with Katie Greifeld. And something that we've certainly been looking to cover a bit more on Business Week is about the trading rules or lack thereof when it comes to lawmakers and other government officials. In a recent column, Bloomberg opinion senior columnist Tim O'Brien writing about a trading ban for lawmakers that makes some sense. Here with his reasoning and his thinking, Tim O'Brien, he joins us on the phone in New York City. Tim, thanks so much for being here with Katie.
Carol.
Yeah, hey.
Hi,
So
Katie.
tell us about this trading ban that makes sense.
Well, it makes sense because it's just a very prudential way of preventing financial conflicts of interest from spilling over into public policy decisions. There's a lot of industries and sectors of our society where individuals can't own stocks because it conflicts with some of their duties. It's a common thing in journalism. It's common in many other fields, but it was woefully late to coming to this Congress. And there was a Stock Act was passed in 2012 that required more expedient disclosure of securities holdings, but and is meant to prevent trading on insider information. But the reality is there's still lots of loopholes for family members and for the timing of disclosures about stock trades that allow members of Congress on both sides of the aisle, I think, to get around some of these restrictions. And that's why you've got people like John Ossoff, a Democrat from Georgia, who with Mark Kelly introduced a bill this week to further tighten some of the rules and regulations around it.
Yeah, Tim, to your point, a lot of us live with trading restrictions. I think a lot of people would read your piece and be surprised that, members of the U.S. government aren't necessarily under those same standards. So this bill that was introduced this week, do we think that it'll actually go anywhere? Is this actually going to pass?
Well, Katie, I think it's going to face a real uphill climb. It's interesting. Ossoff first floated a trial balloon about this last weekend. I wrote about it on Monday. And Ossoff said he was not going to formally introduce it until he could find a Republican co-sponsor because he wanted it to be a bipartisan bill because it's a bipartisan problem. And given the fact that his co-sponsors, another Democrat, suggested he could not find a Republican co-sponsor for this bill, and given the kind of division, that currently exists in the Congress politically, I think it's going to be an uphill battle for them to get this passed. But I think they're going to also get some necessary attention focused on this issue by the simple fact that the bill is in play.
Well, especially if you think about, Tim, right, all the reporting that we've been doing here at Bloomberg, certainly the Fed has been front and center. I think about former Vice Chairman Rich Clarett and others in terms of their investment moves and disclosures and their timing about when they did things against Fed policy moves and communication, even rules around Supreme Court officials. you talk about him wanting this to be a bipartisan proposal, but there is bipartisan push back, both Republicans and Democrats who don't like tightening any of the rules.
Because there's bipartisan money making going on. That's the short answer to that observation. Rand Paul got into hot water over the summer when it turned out that his wife was trading Gilead shares during a time in 2020 when Rand was privy to information about the severity of COVID-19 before that became public information. And it took Paul more than a year and a half to disclose those trades. Nancy, on the other side of the aisle, Nancy Pelosi's husband, Paul Pelosi, is a real estate investor who has a very active stock portfolio and has taken large positions and options of companies like Alphabet and Disney, et cetera, et cetera. And, in both of those cases, in both Pelosi and Paul, there were no evidence of wrongdoing. They hadn't really skirted the rules that currently apply to members of Congress. But the reality of this is that both of those individuals have influence on regulations and laws that affect a broad swath of corporate America and the market. And it's just, it creates the appearance of a conflict of interest at a minimum, even if no wrongdoing occurs.
I mean, I have heard more about the Pelosi's portfolio, I feel, in the past few months than I ever wanted to know. But Tim, to your point that, they were in the bounds of the rules that are in place. I mean, you're seeing the same thing at the Federal Reserve, too. A lot of officials there coming under fire, but again, within the bounds of the rules.
Well, and as Carol, and Congress is not alone, as Carol pointed out as well, there's been a lot of scrutiny of the court system. The Wall Street Journal did a lengthy investigation of the federal judiciary nationwide and a lot of problems that exist with disclosures around federal judges trading in stocks of companies that have active cases before the bench. And the Supreme Court, I've written about some of the problems that exist there with book contracts and junkets, et cetera, that aren't properly, I think, accounted for.
Well, love your reporting, love your columns, and glad we could spend some time with you and look forward to even more. Bloomberg Opinion senior columnist Tim O'Brien. Tim, thanks so much. Have a good weekend. You are listening to Bloomberg Business Week. Carol Massar along with Katie Greifeld, and you are listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
This is Bloomberg Business Week. Carol Massar along with Katie Greifeld. And Katie, over the last couple of weeks, we have been catching up with some venture capitalists, young and old. Alan Patrickhoff, he's actually in our weekend broadcast. He's been doing it for 50 years. And coming up next, it's actually a member of the Bloomberg team who's looking for startup opportunities.
I am so excited for this conversation because we saw a lot of activity in this space over the past year. Would love to know how 2022 is shaping up.
Yeah, some record numbers, right? We talked about, I think, the other day. All right, we're going to get to Karen Klein, founder of Bloomberg Beta. She's going to join us in just a moment. First up, though, back to some of the news of the day. Wrapping up a busy week, Doug Krisner.
No kidding, Carol. Volatility gripped markets today, and we ended mixed in terms of equity price action. The S&P fought back from some early session weakness to close higher by just 0.1%, but we did have the Dow down today by 0.6%. On the positive side, Infotech recovered, and that helped to send the NASDAQ composite to a gain of about 0.6%. A lot of the focus was on the weakness that we had in economically sensitive stocks. I'm thinking real estate and financials. The banks were down after both JP Morgan and Citigroup reported trading revenue figures that were disappointing. Citi, as an example, down 1.3%, but look at JP Morgan shares, weaker today by more than 6%. And as a result, we had the S&P Financial Index dropping by more than 1%. By the way, the real estate group was down about 1.2%, so a bigger hit on that front. Look at the spike that we had in long-term interest rates today. 10-year Treasury jumping more than 8 basis points in yield. We're at 178. Some disappointing economic news, beginning with that retail sales figure. In December, we saw a drop, the biggest one in about 10 months, and it really underscores this idea that surging inflation now is taking a greater toll on consumers. Also today, word that growth in U.S. factory output unexpectedly declined. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Really appreciate it. Doug Krisner there with that Bloomberg Business News Flash. You're listening to Bloomberg Business Week. Carol Massar along with Katie Greifeld on this Friday. And what I love, Katie, about our company, I mean, I love many things. And truth be told, front and center is the people, but also the different aspects of the business that everybody works in, their perspectives and our access to pick their brains about kind of what they're seeing. I feel like it really gives us a wide and deep view of our world.
Oh, absolutely. I mean, just in this building alone, Bloomberg HQ, there's so many different parts of the organization in this building. And I mean, back in the old days, the before times, I mean, every face in the pantry, it felt like it was a new one.
Yeah, exactly. Well, which is why I loved recently catching up with Karen Klein, founder of Bloomberg Beta. She worked previously at SoftBank. She led their team that reviewed all their new investments during a period when SoftBank invested in the likes of BuzzFeed. Their seed round really just has seen so much when it comes to the startup scene. And she joins us on the phone in Florida on this Friday. Karen, so nice to have you with Katie and myself. How are you?
Oh, Carol, it's always a pleasure to speak with you. And hello, Katie. It's great to connect. This was just such a great way to wrap the day, to get a chance for us to catch up.
Me too. I feel that way. It's been a bit of a crazy week, and I think we're trying to make sense of a lot of stuff that's out there and a lot of uncertainties with the outlook. I think about, Karen, the longer we are in this pandemic, and you guys at Bloomberg Beta, you are thinking about how we're working, how we will be working. You know, how does all of that, the pandemic, kind of shape some of your thinking as a venture capitalist and investor, and maybe some of the trends that are with us to stay?
Yeah, so the pandemic has had a profound impact on a lot of the things that we've been seeing. Bloomberg Beta focuses on the future of work, and the pandemic essentially accelerated a lot of the trends and things that we saw where physical space was more of a dependency and we had to find alternatives. So it's been fascinating to see how work is changing now that we need to find new alternatives and strengthen some of the things that we were doing before related to distributed teams and working remotely.
And so what does that translate to into 2022? I mean, it feels like this pandemic is never ending, that remote work, both people like it, but also, I mean, you've seen so many companies around Wall Street and beyond having to delay return to office plans. How does that translate into a sort of venture capital theme?
So there's a bunch of ways that it's affecting us. I mean, we're seeing it certainly around certain areas like learning, right? Like, how do you figure out what you're supposed to do with one's kids, right? Should they be in school? Should we emphasize and move more toward remote types of learning? So there's been huge growth in education. Similarly, around digital health, we had to find solutions because we couldn't necessarily go to visit our doctors physically. So those two have been areas where we've seen a bunch of opportunities. And then just naturally, what's happening in the workplace is changing as well, because it used to be very easy where you could pop over to somebody's desk and ask them how they're doing. And now there has to be, and one of the things we love about Bloomberg, as you were talking about earlier, is you'd be in the pantry and you'd be able to bump into colleagues and get updates, and there'd be all sorts of serendipity that would happen. And we just don't have that now. So we need to turn to online tools, and examples of such, I can give you a couple of them that we've seen, and we like the product so much we ended up investing. And it's things like Donut, which creates a water cooler so that there's more of an opportunity to get to know the personal side of what your colleagues have happening, as well as just to check in, which is also extremely useful during this time.
Well, I love what you said, Karen, too, about serendipity, because I do think about, right, that is so much part of our Bloomberg culture. You run into somebody from a different division, a different part of the business, and it's like, oh, wait, we should be doing this, right? And that's how things happen. I mean, what's happening in this space in terms of innovation disruption? Are you at all a little bit concerned that some of that might slow down, although it feels like the pandemic sped up a lot of innovation, but because we're often having to meet with people virtually, that maybe some of that serendipity is lost in this environment?
There's definitely a benefit to seeing people in person and just being able to read some of the reactions and responses, and around collaborative work such as brainstorming. We haven't yet necessarily cracked the code on how to do some of those well. But the other thing that we're seeing is we're just all getting inundated. There's just too many messages, alerts, notifications, and it's very hard to follow what's happening and keep organized. And so there's been a proliferation of tools that have emerged there too. Like there's a company that we like out of North Carolina that is called Wrangle, and what it does is it allows people to, since we're all living in Slack and Teams, it allows us to stay in some of those chat rooms and be able to approve vendor requests or pass leads on to different divisions within the company.
Right.
So there's certainly a rise in different productivity tools to ensure that some of the things that we used to be able to pop over to somebody's desk and learn about still gets done.
Sit tight for a second, Karen. We're going to do a little bit of news, but we'll come back and continue our conversation. We're talking with Karen Klein. She's founder of Bloomberg Beta. We'll get back to her in just a moment. In the meantime, out to D.C. and our newsroom in the nation's capital and World of National News with Nancy Lyons. Hey, Nance.
Thanks, Carol. Another blast of winter weather is making its way from the Midwest to the East Coast this weekend. Some parts of Iowa and southern Minnesota could see as much as a foot of snow. Meteorologist Bob Oravec with the National Weather Service says this weather trend is expected to last for the next few weeks, especially along the East Coast.
We're in a fairly active, at least active and cold weather pattern across the eastern U.S., and it doesn't appear that we're going to be changing that weather pattern probably until maybe early to mid-February.
Oravec says starting Saturday night, much of the eastern U.S. is expected to get snow, sleet, and freezing rain. The recent Omicron surge is not just affecting business, it's also putting a crimp on many government services most of us take for granted.
Just take the Transportation Security Agency as an example. Right now, more than 3,500 workers are infected with COVID at the agency that handles airport security across the country. The shortage forced 2 checkpoints to shut down at Phoenix Sky Harbor last week. Then there are shortages of inspectors at the USDA. That is slowing meat production and raising prices in Wisconsin, Nebraska, and Texas. An inspector shortage at the FDA could could mean new drugs and medical equipment don't get approved as quickly. And the IRS is already warning of delayed tax refunds due to funding cuts and COVID staffing shortages. In Washington, I'm Nathan Hager, Bloomberg Radio.
The White House says its website, where you can order free COVID-19 tests, will be launching next Wednesday. Officials say the test will ship within 7 to 12 days of ordering. Supplies will be limited to just 4 free tests per home. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much, Nancy Lyons in our 99.1 newsroom in Washington, D.C. We're going to get back to Karen Klein of Bloomberg Beta in just a moment. We're talking about the startup scene. Having said that, when I think innovation and disruption, Katie, I think about Elon Musk.
As you should. I mean, he is a cult surrounding him for a reason. And I mean, we talk about Tesla when it comes to Elon Musk a lot, but he also has the Boring Company. It operates a network of underground tunnels. I just love that name. That's funny.
Not like you're boring or I'm boring.
Yeah,
it's actually
no.
about boring a hole.
Right, like boring a hole in the earth, creating a tunnel. That's what they do. And the CES technology show in Las Vegas, it was a little bit of a mess in terms of figuring out in-person and hybrid, but it was important for the Boring Company because they had a test run of its Vegas loop, and it performed mostly well. It did hit some snags. That was on video. It was tweeted about a lot, but again, mostly well. So a win for Elon Musk and the Boring Company.
Yeah, I'm fascinated by this. Anybody who lives in the New York Metro or any major city, I mean, gosh, out on the West Coast, those highways, you get stuck, you're stranded for long times. Numbers provided to Bloomberg by the Las Vegas Convention and Visitors Authority show that the transit system successfully transported some 15,000 to 17,000 people daily during CSS. Katie, almost half the show's attendees. And according to the Boring Company, the average wait times at its 3 stations were less than 15 seconds. Rides took less than 2 minutes on average, in line with what the Las Vegas Convention Authority predicted when reporters visited the site in April. So that's not too shabby.
Not too shabby. Definitely a win. It is interesting when you think about all Elon Musk's different ventures. You know, Tesla, obviously, Elon Musk's efforts in space. You really don't hear about the Boring Company that much. But again, this was an important proving ground, an important milestone for them. The fact that this was a success.
Right, a real test, right? Putting people through, seeing how it worked, and it'll be curious to see what happens next, as with anything with Elon Musk and Tesla. All right, you're listening to Bloomberg Radio.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It was a mixed day for the equity market. We had the Dow weaker by 0.6%, but the S&P tacked on a gain of just 0.1%, and we had a recovery in information tech after that sell-off yesterday. The NASDAQ composite rose about 0.6%. Curious day, too, because we had a lot of the economically sensitive stocks like financials and real estate being hard hit. The S&P Real Estate Group today down 1.2%, and the Financial Group off 1%. We did have some disappointing trading revenue figures from both JP Morgan Chase and rival Citigroup. JP Morgan shares down today by more than 6%, and Citigroup weakened by about 1.3%. And if you look at the bond market, long-term interest rates spiking quite a bit, with the 10-year Treasury gaining more than 8 basis points in yield. Last quoted in New York at 1.79%. And now we've got WTI crude oil back above 84 the barrel, 84.40 now in the extended session as the market puts its focus on tight supplies. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Let's get back to our conversation. Carol Massar here with Katie Greifeld. She's in our Interactive Broker studio, also streaming on YouTube. Karen Klein is founder of Bloomberg Beta. She is still with us on the phone in Florida. You know, Karen, I was listening to some of the Bloomberg teases for upcoming weekend shows, and I heard Alex Steele talking about the metaverse and life in the metaverse. And I am curious, how do you think about it? You understand technology. You've seen some of the new waves and trends over your career. Will we be working to some form in the metaverse?
Well, there are certainly, one of the things we like to see on technology is to try new opportunities and see where it lands. That one is still sorting itself out, and probably another word that you've heard that's in conjunction with that is around Web3, right, which is the next generation of the internet, and something I think that we're all kind of watching and seeing how it develops. And, you know, hard to tell yet where some of the effusiveness is and where some of the reality is, but some of the things that we've noticed, at least around Web3, which are causing us to pay more attention and start, you know, putting some capital to work, is many respected software developers are starting to spend their time on Web3. Like, there were 34,000 developers in 2021 that worked on an open source Web3 project. And that, to put in context, is almost as many as work at Amazon. So the fact that this elite and time-constrained group is spending their time on Web3 probably means that maybe there's something there, and we certainly want to continue to see more of the inclusion around it, and, you know, greater groups trying to adopt and figure it out.
Well, and a shameless plug, I just want to put in the year ahead issue of Bloomberg Business Week. They get into, Katie, 3.0, like, or Web 3.0, and like what it might mean and for this next phase. But anyway, go ahead.
Yeah, that is a jam-packed issue, and it makes sense that Web3 would be in it because there is so much enthusiasm around this space. And Karen, you kind of got at what I was going to ask, in that it is such a new space. There's a lot of hype, a lot of buzz, but how do you even begin to do due diligence there, evaluate it? I mean, you mentioned, you know, looking at who's involved, that you do have all these big-time, well-respected software engineers. Is that basically what you have to go on at this point? You know, who is putting their energy into it?
That's one of the things. And then I try and think about how is it changing things? Like, how is it making what we currently have better, and look for those pockets. So we were talking about the metaverse. When does it make sense for somebody to be wearing a headset? Like, to put that extra piece of plastic on your head, when do you want to be using AR and VR? And you know, when are there other ways that you can, you know, adopt and potentially experiment with the technology? And the use cases aren't necessarily that clear yet, right? Like, in terms of if you're trying to learn surgery, it might be and you're a student and up and coming, and you can't necessarily, or you want to practice on your own time, it might make tremendous sense. Whereas, you know, collaboration, if you can't meet with people, it might be another potential opportunity. but just to hang out at home and might not be as good as actually reading or consuming something without having to have all the devices attached to you.
There is a point where I just want to detech, and just shut everything off and take all my wearables and everything and just kind of live. But it is interesting. Karen, tell us a little bit more about some of the companies that you guys at Bloomberg Beta have invested in when it comes to how we work.
Yeah, so one of the areas I'm particularly excited about right now is around culture. Because we're spread out, our homes are becoming our workplaces, it's just so important for leadership to be much more intentional around that. And we've heard a lot of talk about this great resignation. I actually think it's an opportunity for the best leaders to upgrade their talent, and that's the way they should be looking at it. And so there are a bunch of tools and technologies that can kind of help us keep in better touch with our employees and know what's going on. And it might be around, corporate training so that people feel valued and can develop the skills they need. And we have a company we invested in called Code Academy that's, just getting sold to Skillsoft because it helps people learn how to code in a much more seamless kind of way. Degree does corporate education training, and so there's some along the training part. I think we're going to see a lot more. There certainly have been some around mental health, and it's now becoming more okay just because to talk about it. And so companies are going to be offering a lot more resources to make sure the well-being of their employees work if they want to retain those employees. So I'm eager to see that transition.
Yeah,
the other thing, which is
go on.
Well, I was just going to say one of the other things that's maybe not even in the culture realm that I think is going to also pop up is because we are working in different places, there are even greater security vulnerabilities happening. And so we're going to continue to see a lot of movement around security. We have a company called Flashpoint, New York-based, and 6 years ago they were a small startup. Now they just announced this week, acquiring Risk-Based, which is a big deal that they're able to, buy another meaningful company and continue to make us all safer. And in particular, doing it around the Log4j challenges, I think is going to be a lot more buttoned up with their combined offering.
Yeah, one of the most interesting storylines for me in 2021 was just all the cybersecurity attacks. Really fascinating. Karen, we have about a minute left, but I'd love to hear, what else is on your radar that we haven't talked about? What other trends are you keeping an eye on outside of, how we work?
So I love that you mentioned Elon and the Boring Company earlier. I went to college with Elon, so I've kind of seen him over the years, and had the pleasure of getting to invest in some of the things he's done. But when you mentioned Boring, one of the things we like at Bloomberg Beta are some of the companies that might be non-glamorous and really called boring, like where you just take a traditional business and you apply some of the software practices that we see that technology companies can adopt, so you create a much more seamless customer experience. And it's not necessarily experienced on the side of the customer, but in terms of seeing the technology, but they just know they have better access to information, a much more robust consumer experience. And so anyway, we like boring companies, like really, really boring companies that use technology.
Listen, we've got to run. Karen, thank you so much. I'm so glad we found some time, and we will definitely find more time in the future. You take care. Karen Klein, founder of Bloomberg Beta. Katie Greifeld, so fun being with you. Next time, though, we're going to be in the same studio.
I am hoping and praying, but have a great